Friends, thank you for being here today. What if I told you that in one of the wealthiest cities in the world, 81% of property investors are losing money every single month? Not struggling, not breaking even, actively hemorrhaging cash. These aren't speculators or Wall Street gamblers. These are ordinary Canadians who were told that real estate was the path to financial security. They were told to become landlords. They were told to build passive income. And now they are trapped in what I call the negative carry nightmare, a situation where the dream of wealth has inverted into a mathematical certainty of ruin. This is not a market correction. This is not a temporary downturn. What is happening in Toronto right now is a structural collapse of the single largest wealth building myth of the past generation, and the scale of what is unfolding should terrify anyone paying attention. Let me give you a number that should create what I call cognitive overwhelm. In the third quarter of 2025, new condo sales in Toronto collapsed to a 35-year low. We are talking about levels not seen since 1990. In a city that is growing by record population numbers, only 319 new units were sold in an entire quarter. Think about that. In 3 months, across one of North America's largest real estate markets, fewer units sold than would fill a single apartment tower. The market didn't slow down. It flatlined. It stopped breathing. Here's the second metric that should alarm you. At the current sales pace, it would take 58 months to clear the existing inventory of pre-construction units. That's nearly 5 years. A healthy real estate market maintains roughly 6 months of inventory. This market is sitting on nearly a decade of oversupply. This isn't a glut. This is a biblical flood of unsellable property. And here is where the mathematics become inescapable. The average investor holding one of these newly completed condos is losing approximately $600 per month just to keep the keys. They are paying mortgages that have doubled or tripled since they signed the purchase agreement. They are paying maintenance fees that climb every year, and they are collecting rents that have either stagnated or fallen. This is what professionals call negative carry. The cost of holding an asset exceeds the income it generates. But let's be clear about what this really means. It means you are paying someone else to live in your property. You have become, in the most literal sense, a philanthropist subsidizing your tenant's lifestyle while your own financial position deteriorates month after month. This is not a temporary condition that will resolve itself. This is a structural fault line. The system that created this disaster is now breaking under its own weight. And what comes next will redefine what Canadians understand about wealth, security, and the illusion of home ownership as a guaranteed path to prosperity. Now, to understand how we arrived at this moment, we cannot start with today's headlines. We must go back to the origin of this disaster. We must understand the Genesis myth that convinced an entire generation to gamble their futures on pre-construction condos. The year is 2019. Interest rates are at historic lows. The Bank of Canada is essentially giving money away. Toronto is in the grip of what can only be described as a pre-construction frenzy. Developers are selling units that don't exist yet, paper condos, and ordinary people are lining up to buy them. But here is the critical detail that everyone missed. These buyers were not planning to live in these units. They were not even planning to rent them out. They were planning to flip them, buy the contract, wait 2 or 3 years for the building to complete, then sell the contract to someone else before closing day and pocket the appreciation. It was the purest form of speculation. No tenant, no mortgage, just ride the escalator of perpetually rising prices. This was the dream. Buy at $800 per square foot in 2019, sell the contract in 2022 for $1,100 per square foot, Walk away with $150,000 in profit without ever holding the keys. It was genius, it was foolproof, and it worked until it didn't. Because what happened between 2019 and 2025 is that the entire scaffolding of that plan disintegrated. Interest rates, which were supposed to stay low forever, according to every expert, exploded. The Bank of Canada, in a desperate attempt to fight inflation, raised rates faster and harder than at any point in modern history. And when those pre-construction buyers went to close on their units, when they were forced to actually take possession and get a mortgage, they discovered something horrifying. The appraisal values had collapsed. The units they agreed to buy at $1,200 per square foot were now appraising at $900 per square foot. The banks would only lend based on the appraisal, not the purchase price, which meant these buyers had to come up with the difference in cash. We are talking about $200,000, $300,000, sometimes $400,000 in additional capital just to close the deal. Money they didn't have. Money they never planned to need. And here is where the simple logic of household finance completely breaks down. Because when you or I take out a mortgage, we understand the rules. We borrow money. We pay it back with interest. If we can't pay, we lose the house. Simple, brutal, but clear. But what happens when you are trapped in a purchase agreement on a property that is worth less than you agreed to pay? What happens when walking away means being sued by the developer for the full purchase price plus damages? What happens when the only way to close is to borrow money at rates you cannot afford from lenders you should never trust? This is where the shadow banking system enters the story, and this is where the contagion that is about to spread through the Canadian financial system truly begins. Think of it like this. You go to your bank and ask for a mortgage. The bank looks at your income, looks at the property value and says, no, the numbers don't work. You cannot afford this. In a rational world, that would be the end of the story. But we do not live in a rational world. We live in a world where desperation creates opportunity, and where that opportunity is seized by what I call the paper hangers, private lenders operating in the shadows of the regulated banking system. These private lenders offer you the money the bank refused to give you, but they charge interest rates of 10%, 12%, sometimes 15%. They offer short-term loans, 1 year, maybe 2, with the expectation that you will refinance into a traditional mortgage once the market recovers. It is a bridge loan, a temporary solution, except the market isn't recovering. And when that loan comes due, you cannot refinance because the property is still underwater. So you renew with the private lender at an even higher rate, or you default. And when you default, the private lender seizes the property and sells it at a loss. But here is the secret that nobody is talking about. These private lenders are not billionaires. They are not institutional investors with deep pockets. They are regular Canadians who took out home equity lines of credit on their own properties and lent that money out at high interest rates, thinking they were becoming savvy investors. They are homeowners who turned their primary residence into a lending vehicle. And when the condo investor defaults, the private lender cannot make the payments on their own HELOC, which means they default on their own home, which means the bank forecloses. And suddenly a single bad condo investment in Toronto becomes a chain reaction of middle-class ruin spreading through the suburbs. This is what I mean by shadow banking contagion. The risk is not isolated, it is networked, and the firewall between the shadow banks and the major institutions, the big 5 banks that Canadians trust with their savings, is thinner than anyone wants to admit. Because here is what the banks will not tell you. They claim they have no direct exposure to these distressed condos. They claim their lending standards are sound, but they have massive indirect exposure through the private lenders. When the shadow banking sector collapses, the contagion flows upstream. The defaults spread, the write-downs begin, And what started as a Toronto condo problem becomes a national banking crisis. This leads us to the system's most crucial secret, which we will explore as this disaster continues to unfold in real time. Now we arrive at the moment where theory becomes reality, where the structural fault lines we have been discussing stop being abstractions and start destroying lives. The third quarter of 2025 marks what I believe historians will identify as the trigger event, the moment when the Toronto real estate market didn't just soften, but broke. The data is unambiguous. Completed unsold inventory swelled to a record high, jumping 102% year over year. Let me translate what that means in plain language. Developers are now sitting on thousands of finished condominium units that they cannot sell. These are not projects under construction. These are completed buildings with elevators running, lobbies furnished, and units sitting empty. And every day those units remain unsold. The developers are paying high interest construction loans. These are not traditional mortgages. These are short-term, high-rate loans from institutional lenders who expect to be repaid quickly once the units sell. Except the units are not selling. What happens when a developer cannot service their construction debt? They enter receivership. That is the polite corporate term. The brutal translation is bankruptcy, and when a project enters receivership, a trustee is appointed to liquidate the assets as quickly as possible, which means those units get dumped onto the market at whatever price necessary to generate cash. This is not a strategic sale, this is a fire sale, and every receivership sale establishes a new, lower price point that drags down every comparable property in the city. We are watching the architecture of the market implode in slow motion. And the evidence of this collapse is everywhere if you know where to look. Let me give you the first canary in the coal mine. In the first 9 months of 2025 alone, 18 condominium projects representing more than 4,000 units were canceled. Not delayed, canceled. Developers looked at the market, looked at their financing costs, looked at the pre-sales, and made the calculation that it was better to walk away and refund deposits than to build buildings nobody wants to buy. Think about what that signal means. These are companies whose entire business model is built on the assumption that Toronto real estate only goes up, and they are giving up. They are admitting defeat. They do not see a future where this market recovers in time to save them. Here is the second canary, and this one exposes the mathematical reality that every investor is now confronting. Resale prices for existing condos are averaging $903 per square foot, but pre-construction buyers who purchased between 2019 and 2022 paid an average of $1,200 per square foot or more. That $300 per square foot gap is not just a loss on paper. It is the difference between solvency and insolvency. It is the air in the bubble that is now hissing out. And when you calculate that gap across a 700 square foot, 1-bedroom condo, you are looking at a loss of over $200,000. These buyers are underwater the moment they get the keys. There is no equity, there is no cushion, there is only debt. And here is the third canary, and this one should terrify anyone who understands credit cycles. Synthetic fraud is rising. That is the industry term for borrowers falsifying their income statements to qualify for mortgages they cannot afford. Fake pay stubs, inflated employment letters, borrowed down payments that get returned after closing. This is not innovative financing. This is desperation masquerading as documentation. And it is the hallmark of a late-stage credit cycle. When fraud becomes necessary to keep the system functioning, the system is already dead. It just hasn't stopped moving yet. Now let me show you why there is no escape from this trap. Let me show you why the exit doors are welded shut. If you are an investor holding one of these condos, you have three options. Let's examine each one. Option one, you sell. You list the property at current market prices and hope to find a buyer. But remember, you paid $1,200 per square foot. The market is now $900 per square foot. You are taking a 25% loss before you even account for realtor commissions, legal fees, and land transfer taxes. On a $600,000 condo, you are walking away with a loss of $150,000 or more. That is not a number that most middle-class Canadians can absorb. That is a decade of savings vaporized. That is a retirement plan destroyed. That is a child's education fund gone. Option two, you hold. You keep the property and rent it out, accepting the negative cash flow and hoping that prices eventually recover. But here is what that actually means. You are losing $600 per month. That is $7,200 per year. If it takes 5 years for prices to recover to your purchase price, and that is an optimistic scenario, you will have bled $36,000 in carrying costs, and that assumes nothing goes wrong. That assumes your tenant pays rent on time every month. That assumes no major repairs. That assumes interest rates do not rise further when your mortgage renews. You are not investing, you are gambling, and the house has all the odds. Option three, you rent it out and hope to break even or minimize losses. But here is the reality of being a landlord in Ontario. This is a tenant-friendly jurisdiction. If your tenant stops paying rent, the eviction process can take a year or longer. The landlord and tenant board is backlogged beyond function, which means you could spend 12 months paying the full mortgage, paying the maintenance fees, paying the property taxes, all while collecting zero rent. And during that time, the tenant is living in your property for free while you burn through your savings trying to stay afloat. There is no good option. There is no path to victory. There is only the question of how much you are willing to lose before you admit the game is over. And here is where this story transcends Toronto and becomes a national crisis. Because what we are witnessing is not just a real estate correction, we are witnessing a liquidity crisis for the middle class. These investors are not oligarchs, they are not hedge fund managers. They are teachers, nurses, small business owners, and young professionals who believed the promise that real estate was the foundation of Canadian financial security. They leveraged everything they had, their savings, their HELOCs, their future income, to buy these units. And now they are trapped. When you trap the middle class in negative cash flow assets, you do not just destroy their wealth, you destroy their spending power. They stop going to restaurants. They stop taking vacations. They stop buying cars. They stop renovating their homes. The entire consumer economy, which is built on the assumption that Canadians feel wealthy because their homes are appreciating, begins to contract. The housing crash becomes a retail crash. The retail crash becomes an employment crash, and the employment crash feeds back into more housing defaults. This is the contagion I have been warning about. This is the unwind, and we are only in the early innings. The liquidity tide is going out, and we are about to find out who has been swimming naked. But the crisis is not contained to individual investors. The structural break is spreading to the institutions themselves. Let me show you how the dominoes are positioned. We are facing what I call a convergence, three distinct forces hitting the Canadian financial system simultaneously, each one amplifying the others. Force number one, the mortgage cliff. A record number of mortgages are renewing in late 2025 and into 2026. These are mortgages that were originated in 2020 and 2021 when rates were at historic lows. Borrowers who locked in at 1.5% are now renewing at 4.5% or 5%. Their monthly payments are doubling. For someone with a $500,000 mortgage, that is an additional $1,000 to $1,500 per month in carrying costs. This is not a theoretical shock. This is not a what if scenario. This is happening right now. The payment shock is arriving at kitchen tables across the country. Force number two, the investor exodus. The marginal buyer, the speculator who was willing to overpay because they believed prices would keep rising, has vanished. Investors are fleeing the Toronto condo market entirely. They are moving capital into guaranteed investment certificates where they can earn 5% with zero risk. They are moving capital into US markets where the economy is stronger and the risks are more transparent. The buyer of last resort, the person who used to show up at every open house with a pre-approval letter, is gone. And without that buyer, there is no price discovery, there is no floor, there is only air beneath the market. Force number three, the economic drag. Construction jobs are starting to vanish as projects get cancelled. Trades workers, electricians, plumbers, drywallers, carpenters are being laid off. These are high-paying jobs that supported families and drove consumer spending. When construction employment collapses, it does not just hurt the workers. It hurts the restaurants they used to eat at. It hurts the suppliers who sold them materials. It hurts the truck drivers who delivered those materials. The housing crash becomes an employment crash, and the employment crash deepens the housing crash. This is a feedback loop, and it is accelerating. These three forces are not isolated events. They are synchronized, they are reinforcing, and they are creating what I believe will be remembered as the Toronto subprime moment, the point where the illusion of real estate as a safe, reliable wealth-building tool was shattered forever. Now we must confront the psychology that is preventing people from seeing what is directly in front of them. Because the data I have just shared with you is not hidden, it is not secret, it is publicly available, yet the vast majority of Canadians, including those holding these toxic assets, refuse to accept what it means. And this refusal is not stupidity, it is not ignorance, it is something far more powerful and far more dangerous. It is what psychologists call normalcy bias, the hardwired human tendency to believe that tomorrow will look like yesterday. Let me explain how this works. Your brain is optimized for pattern recognition. When you wake up every morning and the sun rises, you expect it to rise again tomorrow. When you go to work and get paid every 2 weeks, you expect that paycheck to arrive again in 2 weeks. This is how we function. This is how we plan. This is how we maintain sanity in an uncertain world. We assume continuity. We assume stability. We assume that the systems we rely on will keep functioning because they always have. But here is the trap. When those systems are breaking, your brain resists the evidence. Because accepting that the system is broken means accepting that your entire mental model of how the world works is wrong. It means accepting that the decisions you made based on that model, decisions about where to live, how to invest, what to sacrifice, were catastrophically incorrect. And that psychological pain is so intense that your mind will do anything to avoid it. You will rationalize. You will make excuses. You will cling to hope. You will tell yourself that this is temporary, that the market always comes back, that real estate is always a good long-term investment. But what if it is not temporary? What if the market does not come back in your lifetime? What if the rules have changed and the game you thought you were playing no longer exists? This is the liquidity illusion, and it is the most dangerous delusion in modern finance. Your condominium is worth $600,000 on paper. You can see that number on the real estate websites. You can see it in the tax assessment. You can tell yourself that even though you are losing money every month, you are still a millionaire because the asset is worth $600,000. But here is the truth that nobody wants to hear. If there are no buyers, that asset is worth zero. not $600,000, not $500,000, zero. Real estate is not a savings account. It is not a bond. It is not liquid. You cannot call your broker and sell it in 3 seconds the way you can sell a stock. You need a willing buyer with cash or financing. You need a lawyer. You need inspections. You need time. And in a market where inventory is overwhelming demand by a factor of 10 to 1, where developers are going bankrupt and dumping units at fire sale prices, where every comparable sale is setting a new low, in that market, you do not have a $600,000 asset. You have a $600,000 claim on an asset that may never materialize. Let me give you the clearest example of this illusion in action. In 2008, during the US housing crisis, there were people who held on to their properties through the entire collapse. They watched their $400,000 homes fall to $300,000, then $250,000, then $200,000, and they held on because they believed. They believed the market would recover. They believed their home was special. They believed they could outlast the crisis. And you know what? Many of them were right. By 2020, those homes were worth $400,000 again, maybe more. They got their money back. They survived. But here is what that story leaves out. That is 12 years. 12 years of carrying costs. 12 years of lost opportunity. 12 years of watching their retirement accounts grow while their home equity did nothing. 12 years of being trapped in a city they may have wanted to leave, in a job they may have wanted to quit, in a life they may have wanted to change. And that is if they survived, because many did not. Many ran out of savings. Many got divorced under the financial stress. Many declared bankruptcy before the market ever recovered. Being right eventually does not mean you were right to hold, because markets can remain irrational longer than you can remain solvent. And the definition of insolvency is not running out of money. It is running out of time. When your money runs out before the market recovers, you were wrong. It does not matter what happens 5 years later. You are already gone. So let me be very clear about what I am saying. If you are holding one of these condos, you are not in an investment. You are in a trap. And every month you hold is a month where you are making a bet that the future will be better than the present. But the evidence suggests the opposite. The evidence suggests the future will be worse because the mortgage renewals are accelerating, because the receivership sales are just beginning, because the shadow banking failures have not even started to cascade through the system yet. Your first loss is your best loss. That is not a cliche. That is a mathematical reality. If you are down $150,000 today and you liquidate, you lose $150,000. If you hold for 3 more years, bleeding $7,200 per year, and the market falls another 10%, you will lose $150,000 plus $21,600 in carrying costs, plus another $60,000 in depreciation. Your $150,000 loss just became a $231,600 loss. And that assumes you can even sell 3 years from now. That assumes there are buyers. That assumes your building does not enter receivership and crater your value overnight. This is why I keep using the word trap, because the psychological drive to avoid admitting a loss is so strong that people will rationally choose a larger future loss over a smaller present loss. They will choose slow bleeding over fast amputation. And by the time they realize the limb cannot be saved, it is too late. The infection has spread. Now, let me address the question I know many of you are asking. If this is such a crisis, why are the banks not panicking? Why are the regulators not intervening? Why does the Bank of Canada keep acting like everything is under control? Because they are trapped too. Let me explain the impossible position the institutions are in. If the banks admit that there is a systemic problem with real estate lending, they trigger the very panic they are trying to avoid. If they tighten lending standards too quickly, they cut off the marginal buyers who are the only thing preventing a total collapse in prices. If they acknowledge the scale of shadow banking exposure, they invite regulatory scrutiny and potential lawsuits from shareholders who were told the risk was contained. So they do the only thing they can do. They extend and pretend. They allow distressed borrowers to refinance at higher rates. They allow interest-only payments. They allow amortization periods to stretch to 30, 35, even 40 years. Anything to keep the default from being recognized. Because here is the secret of modern banking. A loan is only non-performing if you admit it is non-performing. As long as the borrower is making some kind of payment, even if that payment does not cover the interest, even if the principal is growing instead of shrinking, the bank can classify it as current. They do not have to take a write-down. They do not have to mark the asset to market. They can maintain the fiction that everything is fine. But eventually, the mathematics overwhelm the accounting tricks. Eventually, the defaults become too large to hide. Eventually, the receiverships become too frequent to explain away. And when that moment arrives, when the big five banks are forced to acknowledge the scale of the losses embedded in their real estate portfolios, the contagion will spread from Toronto to the entire Canadian financial system. This is not a conspiracy. This is not speculation. This is stated policy. The banks have said publicly that they are willing to work with distressed borrowers. The regulators have said publicly that they believe the market will stabilize. The government has said publicly that Canadian real estate is sound. But what they mean is we are going to do everything in our power to delay the recognition of losses until we can figure out how to bail out the system without causing a political crisis. And that brings us to the final question. What do you do? Not what should the government do? Not what should the banks do? What should you do if you are sitting in one of these properties right now, watching your net worth evaporate month by month? Here is the binary choice in its starkest form. You can own assets or you can own claims on assets. Let me explain the difference, because this distinction is going to define who survives the next decade and who does not. A claim on an asset is a promise. It is a piece of paper that says you are entitled to something. A stock certificate is a claim on corporate earnings. A bond is a claim on interest payments. A mortgage is a claim on a property. And in normal times, these claims function perfectly well. You own shares in a company, the company pays dividends, you collect the money, simple, clean, functional. But in a crisis, claims break. The company goes bankrupt, your shares become worthless. The borrower defaults, your bond pays pennies on the dollar. The property falls underwater, your mortgage becomes an anchor, dragging you into insolvency, because claims are only as good as the entity standing behind them. And when that entity fails, your claim fails with it. An asset, by contrast, is a physical thing. Gold is an asset. You hold it in your hand. You do not need a counterparty to honor a promise. You do not need a bank to remain solvent. You do not need a government to maintain confidence. The asset exists independent of the system. And in a moment when the system itself is failing, that independence becomes the most valuable property an asset can have. This is why throughout history, gold and silver have been the ultimate hedge against systemic collapse, not because they generate income, not because they have industrial utility, but because they cannot be inflated, cannot be defaulted on, and cannot be printed into existence by a central bank desperate to maintain the illusion of solvency. Let me be very clear. I am not telling you to liquidate your entire portfolio and buy gold bars. I am not telling you that real estate will never recover. I am telling you that we are in a transition from a system built on leverage, debt, and perpetual appreciation to a system built on scarcity, tangibility, and preservation of purchasing power. The question you must ask yourself is this: do I want to be holding paper claims when that transition accelerates? Do I want to be the person standing in line at a bank during a credit freeze, hoping they will honor my deposit? Do I want to be the person holding a condo worth $400,000 on paper, but worth $0 in a market with no buyers? Or do I want to be the person who stepped out of the line of fire before the shooting started? This is not about making money. This is about not losing everything. This is about accepting a painful loss today so that you have capital tomorrow. This is about recognizing that the game has changed and the strategies that worked for the past 20 years are not just ineffective now, they are actively dangerous. The Toronto real estate crisis is not a local problem. It is a warning. It is showing us in real time what happens when an entire society confuses leverage with wealth, when we mistake rising prices for prosperity, when we build our futures on the assumption that debt will always be cheap and assets will always appreciate. That assumption is breaking. The edifice is crumbling. And those who refuse to see it, who cling to normalcy bias and pray for a return to 2019, are going to learn a lesson that has been taught 1,000 times throughout history. The market does not care about your feelings. The market does not care about your plans. The market does not care that you did everything you were told to do. The market only cares about mathematics. And the mathematics of $315 trillion in global debt, of negative carry across 81% of Toronto condos, of shadow banking chains stretching from private lenders to HELOCs to major banks, that mathematics is screaming one word: unsustainable. History favors the prepared, and the window for preparation is not closing. Friends, it has already closed for many. The question is whether you will be among those who acted while action was still possible, or among those who hoped and waited until hope itself became a liability. The choice is yours, but the clock is not waiting for you to make it.